Hi there, I'm Dean Heskin, President and CEO of Swiss America Trading Corporation. For those of you who've been with us before, welcome back. And for those of you who are brand new, welcome. This is our podcast, The Secret War on Cash. I have with me my co host, Chris Agelastos. Chris, good morning to you. How are you?
Good, good morning. Doing well. Thank you.
Well, good to hear that. Let's get right into it here. We're going to talk a little bit about, we talked about the secret war on cash, the name of our podcast, and we're going to get right into our cash, actually, meaning the US dollar. This is from Watcher.guru. The US dollar share falls 46%, lowest in over 2 decades. 2 decades.
Yeah.
Now, we saw a little bit of a rebounding in the dollar, a little strength in the dollar as the war started, and we actually saw a little bit of a pullback in the price of gold. But this is apparently going to be a very short-lived rally, in so much as it's basically over for the dollar. And it just speaks to the fact that the U.S. dollar, as we've talked about many times, Chris, is
Mhm.
definitely definitely on the ropes, definitely not in a good spot, good position. And the bottom line to the whole thing is what's not helping it is there's just been not only like a lot of moves towards gold by banks, institutions, in individual investors. So that which they've been kind of divesting themselves of dollars or dollar based assets and getting into
Mhm.
metals. But another big thing that's been happening as well is they're getting into just flat out different currencies at times. And so my point in mentioning this, when you have people dumping dollars and you have them, you know, dumping dollars to get into gold, dumping dollars to get into other currencies, where is the dollar going to rebound in this whole process? Where is it going to gain any strength? Because it just doesn't seem as though there's really even any excuse for things to change or for the dollar to recover.
Yeah. Well, and that's the thing. It's got so many different things, which you kind of touched on, going against it. And this is why we tell people, look at the long-term trend, right? Don't just see, oh, okay, look, things popped a little this month or next month, but look at the long-term trend. And what we've seen is central banks diversifying their reserves. So what used to be predominantly dollars is losing some of its market share, and they're moving into gold, and as you mentioned, other currencies like the yuan and the euro. So, and then add to that, the de-dollarization that we've also been talking about a lot on this podcast. That's been gaining a lot of traction. Countries are no longer wanting to be so reliant on the U.S. dollar for their trade, settlement of cross-border transactions, and for their central bank reserves. So you take those things and then add into it the geopolitical stuff, right? The sanctions that we put on countries like Russia or Iran, when we don't like something that they're doing, or when we want to kind of influence their policy. All of those things have caused the dollar to continue to lose its market share, if you will. So, it's not that the dollar is collapsing today, or necessarily even tomorrow, but if you look at the long term trend, and you see, here that we're at the lowest point of percentage reserves over the last 20 years, you can see where this is headed. And that's why people need to be aware of it and prepare for it. And one day there will be a collapse, but again, we don't know. Is that now or in a few months? But either way, let's say we are able to push that collapse off, and it never happens. We're going to continue to see the decline, right? So you need to be prepared for it either way. Kind of like having some food and water in the pantry, for a bad storm that comes through town, or problems at the grocery store, like we saw during COVID, where the shelves were emptying very quickly. It's just all about being prepared, and taking the temperature to be informed on what's going on.
Right. Right. Well, and the picture is pretty grim. I mean, you're talking, the global FX, where the dollar represents 46% of the global FX and
Mhm.
gold reserve, it's at, I think you alluded or mentioned this. it's at its lowest point in 26 years now.
Yeah.
And that's declined, 15 points since 2017 alone.
Yeah.
So like, I mean, this is
Speeding up.
it really is. It's gaining momentum, and it kind of, in fact, it kind of a good segue into the next article here. It's kind of what the dollar is doing in value, or how it's tracking, which this would make sense. It's kind of in parallel to what's been happening with our debt.
Hmm.
And as Jamie, this from newsbreak.com, Jamie Dimon, he says it will be a problem. America's $39 trillion debt will mean volatile markets and rising rates.
Hmm.
And he's right. I mean, you have, our just our interest alone on our debt is in excess of $1 trillion a year. And this is something that, like, now everything that the right let's see, right now the US pays more than 1 trillion a year just on the interest on its debt. And he says that figure is expected to double in the next 10 years, according to the
Hmm.
CBO. That's the Congressional Budget Office saying it. It's not you and
Yeah.
I saying it. It's not Jamie Dimon. That's the CBO who's saying that.
Yeah.
And he said, to put that in perspective, the entire federal government spent 7 trillion in 2025, which also means that the government now spends 20% of every tax dollar they collect just to pay the interest on the previous debt. So he's saying these numbers, and the CBO is saying these numbers are only going to increase.
Right.
Right now, that the 20% of every tax dollar is going towards just the interest on the debt.
Hmm.
So this is where, how is the dollar going to rebound or regain any kind of strength when it's kind of caught in this kind of a whirlpool, if you will?
Yeah, and that's what he's saying here. It won't. It's not going to, unless we make major changes. And the debt increasing is automatically going to happen. Like they say here, those numbers are going to increase. But that's even without taking into account that it looks like interest rates will likely rise over that period of time too, which is going to put even more pressure on the dollar. What that also entails is more or less, I'm sorry, demand for U.S. debt. People and nations are becoming less willing to buy treasuries, and that causes fiscal pressure on our government, as well as higher financing costs. So this isn't a new problem, and he points that out in here. Look, everybody knows about this. Both political parties understand what the issue is, but there's a lack of action and political will on their part to make changes. And unless we see, some real spending cuts and tax reform, stronger economic growth, which hopefully we'll see either way, but unless we see those things working in concert, and our leaders take this seriously, we're going to reach the point where it is a crisis. Right now, we're on our way to that crisis. The writing is on the wall. We're not there yet, but it could happen at any time, as he says in here. And once that happens, now you're dealing with a problem, and you have to make really tough decisions because you put it off too long. It reminds me of college and putting off a paper, a big report, something that was due, and you wait till the last minute, and all of a sudden now it's a huge problem when you could have just maybe done 30 minutes a day or an hour a day and worked towards completing this big project. You wait till the last minute. Now you've got a real problem that can affect you for the long term. And that's sort of where the U.S. sits right now with our debt.
For sure. Well, and as even though we're in a little bit of currently a timeout with the war in Iran,
Hmm.
bottom line is wars aren't cheap. Now,
Yeah.
some people will say, and probably not wrong, that wars over time have proven to be very profitable, but it costs money to be at war.
Yeah.
And, maybe, just maybe, this war somehow spins something positive. But at the end of the day, and Jamie Dimon in this article gets into this, our debt to GDP problem. I mean, how do you strengthen your economy or rebound your currency when our current debt to GDP, gross domestic product ratio, is 123%, which
Yeah.
means that our country owes $1.23 for every $1 we produce in a year.
Yep.
That's horrible math. That's like going to work every day, and let's just say you're collecting $10 a day, and when you leave for the day, you have to give them 11.
Yeah. Yep.
That's not
If you and
that's
I were doing it, we would be out of business, right? We'd be bankrupt. Luckily, the U.S. has some advantages, and they've been able to get away with it for far too long. But there will become a time where that isn't the case.
right. I mean, we don't hope it, we don't want it, but I think more and more we're seeing, people who have been, right, household names in the world of finance and investing, et
Mhm.
cetera, all coming out and saying this is a real thing that's coming. And
Yeah.
how it shakes out, nobody knows. We won't know until we see. But that, again, it just screams to the sense and the logic behind being financially diversified to where you're not putting all your eggs in one basket. You have your stocks, your bonds, your mutuals, your gold, your silver, your cash, some
Mhm.
land. Keep yourself spread out, because one thing is for sure, that at some point in time, and that Jamie Dimon says is he doesn't know if it's going to be 6 months from now, 6 years from now, but at some point in time, something will likely give. So, for those of you tuned in, if you are interested in finding a little bit more out about the secret war on cash, we have a wonderful report we can get to you for free. You can either call or text us at 1-800-289-2646, or you can visit us online at www.swissamerica.com. Thanks for tuning in today. And if you're not subscribed to our channel, please do so, as we'd love to talk to you more in the future. Other than that, have a great rest of your day.
Take care.